In question 2, we have 88 Corporation developing technology for a new piano instruction method that they are developing internally by doing $170,000 of research and development. Well, they went through the process of doing R&D to develop this technology, and on September 30th, 2013, they received a 20-year patent. They expect that, however, this technology will be superseded before that patent expires, and its useful life will only be 10 years. Again, patents are typically for 20 years, but that doesn't mean you have to amortize the patent over the full life if you reasonably think that the technology that you are patenting is going to stop providing you cash inflows before that 20-year period ends. In the process of acquiring this patent, they paid legal costs of $18,000, and we need to record the journal entries necessary to put this patent on the books and record the amortization for the part of 2013 which has passed after we had this patent on our books. The first thing we're going to deal with is the $170,000 of R&D expenditures that 88 Corporation incurred to develop this new instructional technology. Well, let's put this on the books on September 30th, the date that we received the patent. Research and development expenditures by the GAAP guidelines set forth by the Financial Accounting Standards Board do not count as direct costs for developing an intangible. We cannot capitalize these, if you will, to the cost of the intangible that we are receiving. Per our guidelines, research and development costs need to be expended as they are incurred. So we're going to record this as a research and development expense, or an R&D expense, for the $170,000 that we paid. I'll pull this up and make this a little bit bigger for everybody to read. There we go. Let's assume, therefore, that 88 Corporation incurred these expenditures and therefore paid them in cash. We're going to reduce our cash account by that same $170,000 when we recorded our period R and D costs. So as much as companies would like to throw that into the value of their assets, per our guidelines, they can't. Research and development has to be expensed at the time that is incurred. The only costs that you are allowed to capitalize to the intangible that you're developing are the direct costs of acquiring it. In our case, that is our legal costs. So our legal costs of $18,000 when we put this patent on the books, once we receive that from the patent office, is going to be put on the books for just the direct cost of $18,000 that we paid in legal costs to acquire it. And again, let's assume that we are paying this in cash. We don't have any liability to our legal staff or anything. And we're going to credit cash for $18,000 when we recorded the receipt of a patent. And then in part 3, we need to amortize that patent. It's going to lose value over time, like all patents do, because the technology is only going to be useful for so long. It's eventually going to get superseded by better piano instruction technology. We need to reduce its value on our books. We can't carry it at $18,000 in book value forever. So how do we figure out how much we're going to amortize it for? Well, let's first figure out what our normal annual amortization expense would be, and that is the historical cost of the patent, what we put on the books for originally, which we just did, for $18,000, divided by the useful life. And here, our company is saying that even though patents are for 20 years, we think this is only going to provide us positive cash inflows for 10. So its useful life is 10. Well, if we need to remove $18,000 from our books, this patent is going to be worthless at the end of its life. Over a period of 10 years, we should be removing $1,800 in value each and every year. But we didn't get this patent until the end of September, which means we weren't able to use it for the entire year. It didn't provide us with cash flows for the entire year. It only provided them for a portion of the year. What portion? Well, if we got it on September 30th, the only part of the year which it helped increase our company's profitability would have been October, November, and December. That's 3 months. So the portion of the year that passed was 3 out of the 12 months, or 1/4 of the year, if you will. Well, if 1/4 of the year passed where this actually provided us positive cash inflows, we should only be recording an amortization expense equal to 1/4 of what we normally would annually, and 1/4 of 1,800 is $450. So on December 31st, when we make our entry to recognize the amortization on this patent, we are going to debit amortization expense account going up for that $450. And then for intangibles, you have the option of using an accumulated amortization account or taking the value directly away from the intangible. Let's see what 88 Corporation wants to do. And back in our information, it says 88 Corporation does not use an accumulated amortization account. So they're going to take this value directly away from the patent. And patents, like all assets, lose value on the credit side. It's the side they decrease on. So we're going to credit patent for $450 when we adjusted patent amortization.